Welcome back to The True Analyst. If you've looked at your portfolio lately, you've probably seen green across the board. The markets are hitting record highs. But then you turn on the news and hear about slowing growth, rising costs, and a struggling economy. It feels like a glitch in the matrix. Why is there such a massive disconnect between Wall Street and Main Street? Today, we're going to pull back the curtain on the GDP versus stock market paradox. We'll look at why they don't always move together and what that means for your money. First, let's define our terms. GDP, Gross Domestic Product. Think of this as the receipt for the entire country. It's the total value of everything we produced. What you bought at the store, consumption, what businesses spent on new factories, investment, what the government spent on roads, and our trade balance. But here is the catch. GDP is a backward-looking metric. When a GDP report comes out for the first quarter, it's telling you what happened in January, February, and March. By the time you read it in May, that world is already gone. It's like trying to drive a car while only looking in the rearview mirror. Now compare that to the stock market. The market doesn't care about what you did last Tuesday. It cares about what a company is going to earn in 2027. It's powered by expectations, interest rates, and liquidity. It's a giant voting machine for the future. This is the crucial difference. The economy tells us where we've been, while the stock market tells us where we're going. This is why the market can rally during a recession. It's not celebrating the current pain, it's pricing in the recovery that hasn't started yet. Does that mean they never move together? Not exactly. In the long run, think 10 to 20 years, they are highly correlated. You can't have a booming stock market forever if the underlying economy is collapsing. But in the short term, they can drift miles apart. Look at the current U.S. data. In 2023 and 2024, GDP growth was stable, hovering around 2.5%. It was fine, but not legendary. Yet the S&P 500 returned over 24% in 2023 and continued that momentum into 2024. That's a massive divergence. So, what caused that gap? It comes down to efficiency. Corporations have become masters at cutting costs and using technology to protect their margins, even when the broader economy is just okay. The biggest driver of this recent rally has been AI. While the local dry cleaner or construction firm might be feeling the pinch of high interest rates, the mega-cap tech companies are riding a generational wave of innovation. They aren't the economy, they are an outlier. Remember, the market is a leading indicator. It usually bottoms out about 6 months before a recession ends. If you wait for the good GDP data to buy stocks, you've already missed the biggest part of the move. This leads to strange reactions. Have you ever seen a bad economic report come out and the market goes up? That's because the market only cares about the delta, how much the actual number differed from what we expected. A bad number that is less bad than feared is often seen as a win. The S&P 500 is heavily weighted toward global tech and finance. It gets 40% of its revenue from outside the U.S. GDP, however, includes every small business and hair salon in your town. They are two different animals. And finally, never underestimate interest rates. When rates are expected to fall, the market gets a liquidity high. This can push stocks up even if the economy is cooling down. It's all about the cost of money. To wrap it up, don't let a slow economy scare you out of a good market, and don't let a hot market trick you into thinking the economy is perfect. Understand the difference, and you'll invest with much better clarity. If you found this breakdown helpful, make sure to follow The True Analyst on YouTube and Instagram. Thanks for watching, and I'll see you in the next one.